Hey guys, so this is going to be my first video on this channel. I'm going to be posting on here as much as I can. Not sure if I'm going to be getting any traction here or not, but I guess we're going to be finding out together. So in this first video, I want to talk about the FedWatch tool that helps us predict what are going to be the interest rates in the future, how to use this tool, and why it matters. So the next FOMC meeting is next week in 6 days, actually. So on the 17th of September, so next Wednesday, is the next meeting. And the expectation is that the Federal Reserve is going to decrease interest rates by 0.25%. So there's actually right now a 93% probability of a 25 basis point rate cut. So a 0.25% interest rate cut. It's a 7% chance of a 7% chance of 0.5% rate cuts. Now, how does this tool come up to these probabilities? The Federal Reserve haven't announced it yet. Do they have a crystal ball or something? How is this calculated? And why it matters to you, And you can also check here using this tool, future FOMC meetings, what's the probabilities for that? So if I want to look for, let's say, June 2026, there's 8 FOMC meetings per year where the Fed can change interest rates. Well, the expectation for next year, June, is that we're going to be between 3 and 3.25%, the interest rate. So 1.25% lower. That's the expectation, and that's the probabilities. Now, why does this matter to you? Why would interest rates even matter to you? Well, they matter to you because if you invest in anything, any financial asset, all financial assets are price sensitive to interest rates, right? If you invest in bonds, that's pretty price sensitive to interest rates, especially longer term bonds. If you invest in real estate, well, that's price sensitive to interest rates, right? And it's usually an inverse correlation. So interest rates to prices. If you invest in stocks, gold, Bitcoin, all of these financial assets are price sensitive to interest rates. And the way you can really see it is like, if the Federal Reserve reduces interest rates, money becomes cheaper all of a sudden, right? It's easier to borrow money. It costs less. People borrow money. Banks give out loans. And when banks give out loans, they create money out of thin air. So they increase the money supply. Money is cheaper. There's more of it. And when something is cheaper, other things are more expensive, are more valuable relative to that thing, right? So financial assets become more expensive. And then it's the other way around. When money is more expensive, interest rates are higher, then financial assets contract versus money. So there's an inverse relationship. This is why it's important to follow interest rates if you invest in anything, and you have to invest in something because you can't just keep money, right? You have to have some investments in your life. Now, what are the expectations for future rate cuts, and how are these calculated? For example, right now, next week, the expectation is that we have a 0.25% rate cut. How is this calculated? So this tool calculates these probabilities by looking at Fed fund rate futures contracts that are being traded on the open market by interest rate traders. It's looking at their price and using that to give us these probabilities. So it's looking at Fed fund rates, future contracts that are being traded, and based on where they're trading, it gives us what the market is expecting the Fed fund rates price to be at. Now, if you want to take a look at the exact calculation, it's probably here somewhere. It's in methodology, it's probably in methodology if you want to get the exact calculation, but it's looking at Fed fund rates, future contracts that are being traded on, and using that to predict what to tell us what the market expects the Fed fund rates to be at. Now, one thing is this is going to change, right? Because based on what's happening, based on the economic data, market participants will change their mind on where they think the rate is going to be, and they're going to change these future contracts. They're going to trade these future contracts at different prices. So, for example, if we take a look here at last month, let me just go down. Last month here, 1 month ago, the expectations were that we have a 14% chance that there would be no rate cuts and an 86% chance of 0.25% rate cuts. But now, all of a sudden, a month later, so today, the expectation is either a 0.25% rate cut or a little bit of a chance of a 0.5% rate cut. And that changed because, some job data came out and it wasn't looking too good. Jerome Powell talked and said some things that, made it look that, okay, we are going to be having a rate cut. So based on what's happening, these percentages are going to change. This is all that this tool gives us is what the market expects. Doesn't mean it's going to happen, but the market is pricing in this information. Now, why this matters is because if you care about interest rates, you want to know what the market expects. Because if next week on Wednesday, Jerome Powell comes out and they say, okay, there's a 0.25% rate cut, and this is the same. If you take a look at this a day before, the numbers are around the same, then it's not a surprise. We're expecting that. There shouldn't be any crazy price movements. But if there is no rate cuts and the market was expecting a rate cut, then this is very bearish, right? The market might drop because it was pricing in a rate cut and we didn't get it. If we have a 0.5% rate cut, so better than expectation, then the market might go up. So this is why you want to know expectations, because there's only going to be major price movement if there's a surprise around the expectation, right? And the market is expecting this right now. And this is why usually when Jerome Powell, after they announce and Jerome Powell gives his speech, everybody's looking at what he says. There's this meme that goes around about it. Actually, let me find this. Okay, this is the meme. The Jerome Powell, good afternoon. So he walks in after, I'll leave the sound, I guess. He walks in and he says, good afternoon. And all of a sudden the market plummets.
Good afternoon.
Right? So why? Because everybody's looking at what he says. If it's dovish, based on what he says, it changes the future expectation. And the future expectation changes the valuation of all these financial assets, right? So that being said, this is it. I'm not going to drag it on. This is my first video here. So I'm just getting back into the groove of things. So this is the FedWatch tool. You guys should definitely use it. And that's it. I'll see you guys tomorrow.